For the first time since the Great Depression, there was a near collapse of the banking system. The recent financial crisis is widely attributed to a systematic reduction of lending standards in the U.S. Political maneuvering and profit-driven financial engineering were the main factors that ultimately ended with one of the worst recessions in the United States since the Great Depression. Lending standards didn't go into decline overnight. In 1968, best-intentioned politics succeeded by expanding the role of the federal government to one of mortgage insurer. By creating the Government National Mortgage Association, otherwise known as Ginnie Mae, the logic was that lenders would originate mortgage loans if the government agency was insuring them. And in fact, that worked very well. In 1970, Federal Home Loan Mortgage Corporation, or Freddie Mac, was established to expand the secondary market for mortgages by pooling the mortgages together and reselling them as an investment called a mortgage-backed security. Since these securities were issued by Fannie and Freddie, government-sponsored enterprises, they were given similar ratings to government bonds, AAA. Both conservative and liberal administrations enabled and encouraged lending standards to decline in order to boost homeownership data. This trend of pooling mortgages and reselling them as collateralized debt obligations, or CDOs, was extremely profitable for the investment banks. In general, a CDO generated a higher yield than owning the equivalent treasury bond, but had the same ratings. The investment banks developed an insatiable appetite for mortgage-backed securities, especially the ones guaranteed by the government-sponsored agencies. As investors demanded more mortgages, the financial institutions complied by purchasing mortgages not insured by Fannie or Freddie. The increased demand for mortgages was actually a demand for borrowers. You see, it takes a borrower to get a mortgage to package and resell. Slowly but surely, the pool of prime borrowers was reduced, and the mortgage originators expanded to a potentially riskier customer. That's people with lower credit, known as subprime borrowers. At the end of the last millennium, financial engineers came up with a loan called an interest-only mortgage, which, as the name says, allows the borrower to forego principal payments, only paying mortgage interest. Because these loans offered a lower monthly payment, less income was required to pass underwriting. This sounded appealing to politicians because it allowed a larger group of people to purchase a home, which helped with the home ownership data. As the housing markets expanded, financial engineering of mortgages continued to increase the percentage of subprime borrowing. The visual aid that I have with me tonight is a chart that represents the number of dollars in subprime mortgage loans originated, as well as the percentage of the overall mortgage market that subprime represented. In 2005, the first year that the subprime market surpassed $500 billion. And in fact, the two-year period between 2005 and 2006, which was approximately $1.3 trillion, was greater than the 9-year period between 1994 and 2002. This also corresponds with the percentage of subprime borrowing as compared to the total dollars borrowed. In 2004, it was the first time that the percentage was over 20%. The explosion in subprime lending went unabated until 2007, when foreclosures on subprime mortgages reached a 50-year high. Government agencies started to reevaluate the risks associated with insuring the subprime market, and in February of 2007, Freddie Mac announced it would no longer purchase the least creditworthy mortgages. In April of 2007, the mortgage originator, New Century, went bankrupt. In 2007, Bear Stearns shocked the market by admitting that 2 subprime hedge funds that they ran were essentially insolvent. These disclosures, combined with the foreclosure data, caused a mood of panic to set in on Wall Street. Soon after, Bear Stearns, Lehman Brothers fell into bankruptcy. Fannie Mae and Freddie Mac were essentially insolvent and put into a conservatorship. It didn't help that there were a group of speculators betting on the collapse of the housing market. In March of 2009, Robert Lesner in Forbes magazine detailed just how these people were able to bet against the mortgages. The process of betting against these package mortgages would itself not have been possible if it were not for the engineered insurance product called the credit default swap. It's an insurance policy that protects the holder against a corporation defaulting on its debt. These swaps were used to speculate on the collapse of the housing market, and it's rumored that the total dollar value of these swaps was the equivalent of $60 trillion. As panic set in, Congress was forced to act, and in October of 2008, they authorized a $700 billion fund named the Troubled Asset Relief Program, or TARP. Well-known and highly rated companies such as AIG, Wachovia, Citigroup, Morgan Stanley used the TARP funds to prevent bankruptcy. So the question today is one of guilt. Who was to blame for the excess taken by lenders and borrowers? Was it the mortgage originators, greedy investment banks, or real estate speculators and unsophisticated borrowers? In the end, it doesn't matter. Political agendas encourage regulators to not properly assess the risks of insuring subprime debt. The demand for loans to package and sell led to mortgage originators to dramatically lower underwriting standards. While shareholder demanded greater profits, it encouraged investment banks to over-leverage themselves and assume more risk than their balance sheets could handle. As a result, an entire industry of financial companies became illiquid, and in some cases overnight. These combined factors resulted in one of the worst financial recessions the United States has seen since the Great Depression. Are there any questions?
Were the mortgage originators responsible if the loan went into default?
Not really. As long as the borrower made the first month's payment, they had no responsibility to the loan.
I've heard the term too big to fail. What does that mean?
The term was started using by insiders, and then the press picked up on it. In essence, it's the idea that if these large financial institutions were allowed to fail, it would lead to a systematic collapse of the entire banking system. Thank you.
7